Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Okay, three key risk scenarios. Again, I don't think there's a lot of surprise here. A lot of this has been talked about and in the market. Number one, U.S. double dip recession. A lot of people think no way, no how, but we think yes way, yes how, and I'll give you why. The probability probably lower of it not happening at the moment, but we still think this is a possibility we have to stay open to. European Monetary Union breakup. We've been talking about this for a long time. We wrote a report, a big report back in June of 2009, explaining why we thought the European Monetary Union had a good chance of breaking up, and things are playing out right along the lines of what we laid out. Again, it wasn't rocket science. It was stuff that was in the market back then. Understanding that the structure of the euro really is very much an artificial construct. And the bottom line is the European Monetary Union and the continent of Europe as it exists at the moment is not fertile ground for a common currencies. And common currencies have generally broken up in history. All of them have broken apart. We think the euro will in time, and we just laid out the structural reasons why the euro never made sense as a currency. This is why when everybody, back when the dollar was in the midst of the bear market, we weren't. I mean, you're always concerned when your currency is getting killed, but we never believed this stuff that the euro would displace the dollar as a world reserve currency because we knew the structural flaws were immense in the euro, and it was only a matter of time before we had some type of global conflagration in which you'd start to see these structural inconsistencies come to the fore, and that's exactly what happened with the credit crunch, and it's one of the reasons we definitely went long dollar in a big way as that credit crunch started to play out, and it did quite well for clients during that. The other scenario is Chinese credit bubble, and without a doubt, as I said, no matter how you slice it, China has a huge credit bubble. Does it mean it'll pop? No, it doesn't mean that at all. China seems to have the ability to get through a lot of these relative financial problems that we look at from the West. And one of the reasons they've been able to do it is because just a massive speed of growth. What looked like it would have been a big problem in a relatively normal growth environment, China tends to just blow past these because of the growth, because of the in the economy. The reason we think this time there's a problem is because we don't see the relative background growth in the world that we saw before when China had the same type of bubble problems in the past. And we say that because of the fact that China is still highly dependent on demand from the West. And if the European Monetary Union is in trouble, and even if it doesn't break up, well, there's going to be slower growth there. And from a relative standpoint, there's no way we think the U.S. consumer is going to get back in the game where they were from 2002 to 2007, bear market in the dollar, which was a massive demand situation of the U.S. consumer spending money like a drunken sailor. We think that game has changed. So from a Western standpoint, the relative growth in the Western economies, which China is still dependent on, it's not going to be there. And this is why this credit bubble this time is so much more dangerous than it's been in the past. The relative growth background for them to just zoom out of this we think is very, very different, and this was why this time, to put it, bottom line, the probability of it popping is much, much greater, and I'll take a look some more of that in a second. First, just looking at this idea, of a double dip, and again, we could spend all day on any one of these scenarios, so I'm just going to touch on the major points. Hopefully, try and touch on the major points here, and then just get to your questions. Our concern is, and if you start from the premise that, and we do from an economic standpoint, we don't believe the Keynesian economists are right. We're definitely more of a believer in very much the hard money school, or even Milton Friedman's side of the fence, and others that say that government expenditure does nothing but take credit, take wealth from the private sector. So initially, you see this front end loading. You see the front end loading from the U.S. government. Everybody hear me okay? Can you type a Y in there? Gentleman just said he didn't have any sound. If you guys can hear me okay, could you just type a Y in the... Great. Thank you. Appreciate that. We've definitely seen growth in the U.S. economy. There's no doubt about it. But I think if we look at this, we have to just say that this growth has just been from this front-ended massive public debt that the U.S. Government has thrown into the economy. And if you run from the assumption, as we do, or work from the assumption, that we do, that this is just transfer from the private sector to the public sector and does nothing in terms of overall wealth for the U.S. economy, this will start to, the growth that we've seen really is the steroid growth process, and this will start to slow down. The reason this is important is because we haven't seen the unemployment situation improve as dramatically as we would hoped. And I know a lot of people say, and they are correct, that unemployment is a lagging indicator in a recession. And that's true. But we think this particular recession, and we said this isn't your grandfather's type of business cycle that we've seen here because of what's going on in the global economy because of the credit crunch. So we're still very, very concerned about unemployment. And until we see that number improve, we think that the probability of the U.S. double dip is still on the table. The other major concern we have is a stock market correction. The stock market really has played a big role in terms of creating feel good for the U.S. consumer. It's a big wealth driver for the economy. A lot of loans, although we haven't seen a lot of loans, a lot of collateral is based in the U.S. stock market. We think stocks are way ahead of themselves. So if we see a major correction in the stock market triggered by whatever event, and we don't see a rebound in the employment that we'd like to see at this stage, this relative stage through this recession, we think that, again, that's just another add-on factor when we're not going to have the same type of juice coming from the U.S. government. The Eurozone demand, the Chinese currency problem, and the U.S. double-dip recession really are all tied very much together. So even though I showed these three, and I wanted to make that point, let me make it. Let me step back here. Even though I show these three as separate scenarios, the reality is all of these are very much interlinked. If we see a U.S. double-dip recession, we're going to see more problems in the European Monetary Union because that's going to zap demand from German exports, which is going to put more pressure on the Union. If we see a double-dip U.S. recession, that means less demand for Chinese goods, that we have a massive excess supply at the moment, so that goes together. If the European Monetary Union, now let's say this one happens, European Monetary Union pops, it's a major global systemic event. You're going to see credit lines pulled in all over Europe first, and then probably to a large degree from some of the U.S. financial banks, so there's less lending there. It adds to the potential of the double dip. It takes a huge major consumer out of the market for China. If China were to pop independently of these two, the pressure then goes on the European Monetary Union because China is no longer going to be buying those euro bonds, and a lot of U.S. stock market growth is predicated on this China bubble continuing and the music playing in China. So even though we look at these three scenarios separately, they are very, very tightly interlinked at the same time.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.